Hey, good afternoon and welcome. I am Matt Price. It looks like a handful of names are still trickling in here, but early Merry Christmas, Happy New Year. We wanted to end the year with our 12th and final monthly market update. As in the past, probably 10 to 15 minutes. We'll leave a little time at the end for questions. Typically, people ask most of their questions by way of email or phone after the presentation, but please don't be a stranger. Type something in if something is top of mind as we're going through this. Quick review, it looks like most everyone on the call are current clients, a few other friends joining as well. Randy would try to tell you he's my older brother, but he is my father. Myself, Matty Kearns, make up the three advisors of the Price Group, a retirement niche. As we have discussed, over 80% of our clients are retired. We follow a fiduciary standard. We think that's really important. 50 plus years of experience. I've been with Randy, hard to believe, 14 years. So it's been a lot of fun. But here on the left, you can see a little bit of an agenda of the items that we'll discuss, just looking at 2024 in the rearview mirror. And then starting next month, or for next month's monthly market update, we'll do some of the themes of investing, what we think 2025 might bring as it pertains to the economy, interest rates, etc. But let's start here with upward revisions. What this means is companies reported better earnings than most everyone anticipated. And so analysts that follow each individual stock on average had to make more upward revisions to their price targets for that company than on average. So it's actually the most increases in revisions to earnings dating back to the late 1990s. So call it 25 years or so. So historically, the late 90s was kind of the end of a bull market. We all know what happened in 2000, 2001, 2002 being negative years in the stock market, but take that out of it, an upward revision in what analysts expect companies to make is typically a positive sign that the company has strong fundamentals on the balance sheet, income statement, and other parts of the company. Also looking back, transitioning to inflation here, 2024 will be the year marked by a disinflation environment. And just to review, that does not mean that the price of goods, whether that's eggs, milk, bread, go down the list of items at the grocery store that seem to be moving higher. That does not mean these prices are moving lower. What that means is these prices are not increasing at such a quick clip. The devil's advocate argument to this was, I read an article earlier this week that eggs for November last month, the price of eggs actually was up over 8% year over year. But all in all, inflation has really slowed through 2024. You can see we're just shy of that 3% number, at least on this chart, by the way the government does measure inflation. You'll hear Mr. Powell, the Federal Reserve Chair, talk about how the goal would be that 2 to 2.5% range. So overall, great progress made. Still a little bit more room to go. The stock market does not like the news that was announced this afternoon. The Federal Reserve actually cut interest rates by 0.25%. So they seem to think that inflation is under control. The reason the market did not like it, though, was they insinuated there might not be as many interest rate cuts over the next 6 months as investors had hoped for. So a soft landing, what does that mean? Soft landing versus hard landing. If you're in a Boeing 737 landing at Hobby or Intercontinental, you want that landing to be soft. And the same would hold true with any type of slowdown in the economy. So thus far, we've had a soft landing, meaning no recession. What does that look like moving into 25? We'll talk about that more next month on the monthly market update, but interest rates have slowly started to move lower like we discussed. We think it is possible, dare I say probable, that there is a a soft landing, no recession over the next 6 to 12 months. We started talking actually about recessions. It was end of 22 or early 2023. So it's actually been, almost 2 full years now on us discussing this, and there hasn't been a recession yet. The consumer, which makes up about 2/3 of the economy, still continues to be strong. Randy and I get the question a lot, what keeps you up at night? And for us, the answer is the national debt for the country. But we'll spend a little more time here in the next few months talking about that in more detail. 2024, also a year where we saw spreads decline. What do I mean by that? Well, the light blue line there, or the North Carolina Tar Heel blue, those are some high yield bonds, or maybe referred to as junk bonds. And then the darker blue line are the investment grade bonds. And this is specific to clients who have the taxable fixed income strategy, whether it's in an IRA or an after-tax account. But we gravitate more towards some of the higher yielding bonds based on how we see the economy moving forward. But we're also looking at it on a relative value. And what I mean by that is, how much more are we getting for some of the junk bonds or the high yield bonds when compared to their higher grade or investment grade counterparts? And you can see now the spread, or the difference between what the high yield bond and the high grade bond are paying you, is really, really small. So we don't think there's really a ton of value in the taxable high yield bond space today. And you would see that reflected in what you currently own inside of that taxable fixed income strategy. Now, the tax-free market, or the municipal bond market, a little bit of a different story. We still think there is some value with some of the higher yielding tax-free bonds, but the taxable bonds, not nearly as much as we've seen over the past few years. Cash is still not trash. So with that, what I mentioned, Mr. Powell, the Federal Reserve, saying that they're going to reduce interest rates by 0.25%, your cash is still going to be yielding north of 4% if you're utilizing our institutional money market. So we think it's still a okay to good place to hang out for some short-term needs or expenses that might be coming up in calendar year 2025. With that being said, we do not think that cash is a good long-term investment strategy. But for the time being, still making 4+%. It beats a poke in the eye with a sharp stick. Equity markets up 20+%. It depends a little bit on which index you're looking at. The Dow Jones, probably the most prominent index, is up a little less than 20% for the year. The S&P 500 is up north of 20%. But it's back-to-back 2 great years to be stock investors. I look back at our first webinar of 2024, and what Randy and I had kind of presented was that we think 2024 will be an okay to a good year for the stock market. We were hoping in the range of anywhere from a 5 to a 10% rate of return. And thus far, we were wrong. This is something we are very happy about being wrong about, that stocks are up more than we had anticipated. But part of this is we think the markets have a little bit, the old saying goes, buy the rumor, sell the news, as it pertains to what Trump has said he's going to do to help the economy. Deregulation, less taxes, things that the markets typically like hearing. We think a lot of that is currently baked into the stock prices. November was one of the best post-election months here over quite a few years. So moving forward, we think 2025, and we'll talk about this more next month, it's going to be a little bit more choppy. Markets up a little, markets down a little. We think the market could, at the end of the year, just be moving sideways. That's the case. Dividend stocks are typically a good place to invest in a period of choppiness, like what we're at least expecting 2025 to be. Earnings broaden. This is something that is actually really exciting for Maddie, Randy, and myself. We wrote a few blogs this year on how the stock market as a whole, the S&P 500, is concentrated, meaning there's 7 or 8 stocks that really are driving the performance for the stock market. And you've heard of all the companies, Tesla, Amazon, Google, Netflix. Go down the list of the large tech companies that have had good performance dating back to really the last few years, maybe absent 2022. But we've seen that diversified a little bit. So if the S&P 500 has 500 companies, we're talking about the top 8 have historically done really, really well. The other 492 are starting to pick up a little bit of the slack. And that's a sign of a healthy market when there's a real broad participation in the companies that are moving higher. So that speaks a lot to the type of companies that we do own in our dividend growth portfolio. We're not necessarily focused on the large tech companies, that top 8 I mentioned, just because they typically, with the exception of Microsoft and Apple, don't pay dividends. So a broad, healthy earnings report is a good, healthy earnings report. And we started to see that a little bit here in the chart. You can see much more kind of in the second half of the year. Large stocks outperform small stocks. So most all of our clients, I said earlier, 83% of our clients are retired. We gravitate more towards the larger stocks, just because the larger stocks tend to produce more income than the smaller stocks. But the large stocks have once again outperformed. It's been a while since the small stocks actually have done better. At some point, we'll have a reversion to the mean where small stocks do come back with a roaring success, but we did not see that this year in 2024. And I feel a little bit like a broken record bringing this slide up again. I've been, like I said, with Randy 14 years. We've been saying this, I think, literally since my first day 14 years ago, how the U.S., we expect it to outperform international moving forward. That once again was the case in 2024. We like to say U.S. stocks are the cleanest shirt in the dirty laundry. And there's a lot of data to suggest that that should continue here in the short term. At some point, that trend will reverse. But for right now, we are really comfortable with U.S. stocks. And really, a lot of these U.S. companies actually are picking up some what I consider artificial international exposure. And to explain that a little further, companies are just getting a lot more of their revenue from overseas. So they're still US-based companies, but they're growing in parts of the world outside of America. So a big part of their revenue streams do come from outside the US, but they're just domiciled here in the United States. And then last but not least, a bifurcated commodity year. There's a real divergence here between gold and crude oil. Crude oil has sold off for the second half of the year. Gold had a little bit of a pullback in the fall, but really has just continued to move higher. We think moving forward, crude prices should stabilize a little bit, but time will tell on that front. But overall, 2024, the stock market did better than we would have hoped or expected. And then the bond market had a pretty, I'd say, a year that we did expect. The bond market up 4 to 5% for the year, which translates to clients got their income. The bond prices really didn't move up in value. They really didn't move down in value either for the most part. So I know that's a lot looking in the rearview mirror. We think that's helpful to do, at least as we're approaching the holiday season. But with that being said, I am Matt Price, Randy Price, Maddie Kearns, Preston, Tiffany, and Melissa. Wanted to say thank you. Another early Merry Christmas. We will be here for the rest of this week. A little bit light in the office next week, but look forward to hopefully catching up soon as the new year is right around the corner. So Thank y'all. Take care, and please let us know if you have any follow-up questions.